Relevant costing. Relevant costing is a short and long-term decision-making tool. Managers are faced with decisions in executing their duties. In order to make those decisions, managers would need relevant information. Decision-making involves choosing between alternatives. We classify costs for purposes of assigning costs to cost objects and calculating profit. Examples of decisions managers make: make or buy capital investment decisions, pricing decisions, special orders, product lines decisions, sell or process further, adding or dropping parts of the operation, product mix. Terminology. Quantitative factors are expressed in monetary terms, e.g. expenses, income. Qualitative factors are not expressed in monetary terms, e.g. reliability of suppliers, employee morale, product quality. Differential or incremental cash flow. Difference in cash flow between two alternatives. Differential or incremental costs. Difference in costs as a result of an alternative. Avoidable costs. Costs that will not be incurred if another activity is undertaken or when a product or service is dropped. Unavoidable costs. Costs that will still be incurred even if a product or service is dropped. Traceable costs. Costs that can be directly imputed to a job. Product or cost center. Replacement costs. Cost of replacing a product or asset. Thus the current or future market price. Opportunity costs. Forfeited income or contribution margin, or the costs that arise as a result of an opportunity to earn income being sacrificed. Sunk costs. Costs that have already been incurred and cannot affect the decision. Deferred cost. Costs that can be shifted to the future, with more or less no effect on the efficiency of current production. Examples of qualitative factors: availability of cash, inflation, employees, customers, competitors, timing factors, suppliers. Pricing decisions. Short-term pricing. Example: special order, if capacity is available. Any price higher than variable cost will make a contribution to fixed costs. If capacity is not available, then variable costs plus cost of capacity, for example, overtime. Lost contribution on existing products, additional fixed costs. Note: special orders at reduced prices may not reduce normal sales. Qualitative factors for a special order. Does the business have spare capacity? Would the special order be completed in normal hours? Could the special order lead to more orders on a regular basis? Would the special upset existing customers if you charged a lower price? Dropping a product or segment. If contribution is negative, product or segment should be dropped. If the product is making a contribution greater than its avoidable costs, it must not be dropped, because it will be contributing towards unavoidable fixed costs of a company as a whole. A product or segment can be added if has a higher contribution than current ones, or in case of a restriction has a higher contribution per limiting factor than current ones. Qualitative factors of dropping a segment. Will dropping this product negatively impact sales of complementary products? What will happen to workers if the product line is shut down? Will shutting down the product line have negative effects on the environment? Make or buy decision. Where capacity is available. Compare variable cost of making the product with purchase price of the product. Where capacity is not available, compare the full cost of making the product to the purchase cost of the product. You need to consider volume in making the decision. There will be a point or volume where decision to make or buy will yield the same cost or profit. This is known as point of indifference, as it would not matter at this volume which decision. When just looking at the numbers. Qualitative factors of make or buy. Buying could free up capacity. When buying, you will not have control over quality, dependency on supplier for delivery times, little control over the purchase price. Effect on personnel when retrenching them, create employment if making multiple products. Where there is limiting factor, an option to buying products exists. You would need to calculate the differential contribution per limiting factor.